Hi, good evening, all of you. Today we are here to talk about islands of opportunity, the key sectors with growth potential. Now, when we talk about growth potential at the onset, I must tell you that the AMC is particularly bullish in sectors like infrastructure, like real estate, consumer durables. And basis that, over the next half an hour, 45 minutes, we're going to maneuver our conversation. I have with me joining in right now, Nitesh Jain, Jonas Bhutta, Chanchal Khandelwal, as well as Dhaval Shah. Gentlemen, hi, good evening. Good to have all of you on board. Dhaval, let me start off with you, considering you are tracking, if I can call it, the most fragile sector right now, consumer durables. Uh, you know, largely the input cost pressures, the entire inflation around us, everything from crude or fuel rather, to just everything that we're consuming right now is just getting so expensive. And that's the first port of call where consumers are going to get a little price conscious when it comes to consumer durables. What, according to you, Dhaval, then are going to be the key demand trends that you decipher in this post-COVID world? Or do you think the consumer is going to continue buying back with a vengeance and not take a look at their pocket?
Sure. So, let's look at demand in the post-COVID era over the last 2 years, how things have actually panned out. And the first thing that you would see that, post the opening of lockdown, many people were positively surprised with the kind of, the demand uptick which was there, or the pent-up demand which was there, across the consumer durable sector. And largely, people looked at the reasons to see that why is that happening, and we figured out that there was a lot of reverse migration of labor from urban areas to rural areas. There was urban consumer who wanted to buy things like, microwave ovens or dishwashers, where sales went up 3x, 4x, largely to make their lives more comfortable in the absence of any other help that you're trying to look at when there was a lockdown. And it was a euphoric year of FY21, where, there was a big delta change in demand that you were trying to look at. Over the last 9 to 12 months, as you rightly pointed out, because of inflationary pressures, there is a dichotomy here when we look at demand, numbers in an overall sense, that whatever is related to the mass segment is witnessing, lower volumes. In many cases, volumes are lower by 8 to 10% on a YOY basis, or even a, 2-year CAGR basis, slightly negative on an overall volume basis that we're trying to look at from mass segment, which is where the pinch has been the much harder because of inflationary expectations. But premium segment continues to do well. So any company which is geared towards premium segments continues to see very robust numbers. They are not only being able to, pass out the whole of inflation which has been there, plus there has been a decent volume growth, which is there on the premium segment. So that is the near-term outlook that has been there on the overall demand side, and we would continue to think that will continue over the next, 12 months also. But more importantly, we should not lose sight of, penetration levels in many of these sub-segments. Like, you look at refrigerators, we are actually, as in India, having a penetration of around 33%. So 1 in 3 homes actually own refrigerators today. Or washing machine is at 15%, and room AC is only at 7 and 8%. So that does say that there is a long runway of improving penetration levels ahead of us over the next decade that we're trying to look at, which makes this whole consumer durables investment a great hypothesis. What are the levers where this improving penetration can typically happen? First one clearly is that globally we have seen that as your per capita GDP improves, you invariably find because of the improving per capita GDP, you find that there is an increase in the consumer durables offtake. Second is access to electricity, and that is where India has covered a lot of ground over the last 5 to 7 years. Particularly if you were to look at the north and eastern part of India. Over the last 5 years, there has been a sharp improvement in not only the availability, but also the quality of electricity which is available there, and which is leading to improving penetration in a lot of small ticket consumer appliances like kitchen appliances, mixer, ovens, and etc., as well as large appliances that we're trying to look at. So I would say, yes, the next 12 months looks a bit challenging for the mass segment. But at the same time, given the low penetration levels, this looks like a good structural story from a next 5 to 10 year perspective that we should be looking at from this segment.
Sure. Nitesh, at the other end of the spectrum is the sector that you track, infrastructure and cement. What kind of opportunities do you think lie for the infrastructure sector in India? And what kind of reforms do you think the government has undertaken as we come out of COVID to try and help the sector in the recent times? And, similarly, in some sense, just about every sector is getting marred with input cost pressures, and the same goes for cement as well.
So basically, the key enablers for the infrastructure in the country are basically two factors, right? One is the interest rate, and the other one, the important one, is the government finances. Now, if you take a historical backdrop, clearly these two factors right now are quite supportive. We would have seen the GST collection number, monthly numbers, or the advanced tax collection revenue numbers of the government. And also the interest rate in the country compared to the historical trend are quite low. So my sense is that these are conducive for a long-term infrastructure build-up. Our country a lot has to be done in the future. And in this backdrop, if you look at the government of India, a couple of years back, they have come out with the NIP, the National Infrastructure Pipeline, wherein they have put across nearly $100 trillion worth of outlay over the next 5-year period. So I would say there are it's a very broad sector or broad space to look at. But clearly, two things which stand out, which are also critical from a capital market point of view, which gives the investable opportunities as well, are highways and the water related infrastructure. So two schemes which are part of the NIP. One is the Bharatmala project phase 1 and phase 2, wherein the government has said they will build nearly 70,000 kilometers of highways. Out of the 70,000 phase 1, phase 2, 18,000 kilometers have already been awarded and are under implementation. And second big opportunity which I can see on the water side, wherein they've committed that in next 5 years, each and every household in India will have a potable drinking water. And these two things, we have actually seen implementation on the ground. The listed companies in India, they have started getting orders. Implementation is already in place. So all in all, it's quite positive. And one more thing is, it's quite domestic sector, right? No matter what happens globally, I think the infra spending will continue in India. As far as the input costs are concerned, you're right that steel and cement prices have gone up, which are nearly 50% of by and large any construction thing. So there could be some impact on the projects, but looks like they will cool off once this entire global things get subside. So that's on the infra. On your point on cement, you're right that historically in India, particularly large investors have always played infra space through cement routes by investing in cement companies. Because the reason is, if you look at cement as a sector, 15 years back, cement was around 150 million ton of capacity. Today, it is 500 million tons of capacity. And even if today you add the balance sheet of all cement companies, you will find hardly any borrowings on their balance sheet. At the same time, I would say we haven't seen any large equity dilutions or equity raise or IPOs or private equity. So this 150 to 500 figure, they have simply reached by investing their own cash flow, which itself is a big positive. It says that the inherent cash flow generating capacity of cement industry is huge. Therefore, it has always remained a darling of investors. But I would believe there are opportunities in the pure infra space also, because today, if you look at, we can hardly count any infra company which is more than $1 billion market cap. So I believe that in the next 5 years, I think many more can be built up there.
Sure. Jonas, if Nitesh is that bullish on infrastructure as a sector, I bet you think industrials are going to do very good in the next 2 to 3 years, wouldn't you?
Yeah, absolutely. So picking up from where sort of Nitesh left, so there are a couple of other things that sort of are driving demand for industrial. So some of them are largely globally induced, things like China plus one, which is more a post-COVID realization by global companies looking to reevaluate their supply chains, and which is where sort of India fits into the picture. The other is, again, global countries sort of incrementally becoming more uncompetitive in the overall scheme of things and are looking at other avenues to produce products from. So these are two global trends that we are seeing that are benefiting a lot of industrial names. But there are a host of other domestic themes that are seeming to be playing out for the engineering sector. First is the organized move, so move from the unorganized sector to organized sectors. The second is the localization. So, post-COVID, we've had a localization drive, say, for instance, in the defense sector. In fact, even today, the government announced a new list of products that will be locally manufactured. The third is the PLI schemes. Again, something that was launched a couple of years back, where the government envisages roughly 2.5 lakh crores kind of investment incentive, which will lead to a 4 lakh crore kind of investment by the beneficiaries, and could potentially drive a 10 lakh crore kind of value addition to the overall scheme of things. And last but not the least is a host of sectors that were on a capex holiday for the last 5-6 years are looking to come back, at least for the next couple of years, in terms of capacity addition. So that is the cyclical bit. The former 4-5 trends seem to be slightly more structural in nature. But overall, over the next 2 to 3 years, I would believe that all of these things put together would lead to better times for the industrial sector.
Chanchal, where lies real estate? Because, real estate, the sector that you track closely, is coming out of a decadal bear market, right? We can see that reflected on the stock prices. But, the underlying theme remains the same. Real estate needs cement, real estate needs steel, real estate needs labor costs, and all of them have seen a big spike in inflation. At the same time, the big question really is whether demand is really that strong that, really guys can actually up prices and that will get absorbed. Or do you think they'll end up hurting margins at some point or the other?
Thanks, Aisa. If I look at real estate as a sector, and if I take a step back, if you see 2016-17 is the first time when the reform started. RERA was the biggest reform. What RERA did was that from companies who were taking out cash from the unit level of the project and taking it at the company level and funding the cash flow, that was disallowed. That means that the project money at the project level has to be used. Then ILFS crisis happened, which further reduced the cash flow in the sector, and then you had DEMON and GST. All this made sure that the tightening of this sector, the cash flow or the fund requirement of the sector was tightened. And that was the reason the sector itself went through a big correction. Now, if I look at from a COVID world, post-COVID, all of us realize the importance of home, not just owning a home, but owning a better and a bigger home, right? So from that perspective, 2021, as I tell it, it was a start of a real estate cycle. It was like a Goldilocks situation when the interest rate was at an all-time low. COVID made people realize the importance of home. The consolidation in the sector, which was started was happening, and the inventory in the system was almost at 4.5-5 years. There's 10 lakh houses which was not sold. In fact, in 2021, the absorption was higher than the launches for the first day in the decade. And normally the cycle starts when the absorption is higher than the launches. And today the inventory is almost at 2.5 or less than 2.5 years. And I think this cycle which has started will continue for some time. And the reason of belief is that, IT as a sector has come back and the kind of salary increase in this sector which has seen is almost is high, and we think this IT boom will continue. The other thing, if I look at the Naukri job index, is almost at a peak, and I think that Kunal and Jonas and Nitesh pointed out that the revival in the industrial, that is creating job in the market. So demand from that job creation is happening. The industry has consolidated, and that's where the cycle will revive. As far as price increase, which you highlighted, the cement and steel price increases, in last 1 or 2 years, developers have not taken any price increase. For the first time in last quarter, they've taken a price increase of 5 to 6%. And this price increase of 5 to 6% is in line with the increase in the price of the raw material. They are not like the last cycle when we saw developers increasing prices 5%, in fact, every quarter. This time they have not taken price increase. There is a lot of cushion in the price increase which can happen going forward. And so margins from that perspective will be protected.
Absolutely. Though there is one caveat to that, Chanchal, considering COVID is over and all of us are back to offices, we needed bigger homes, but 2 years back, not anymore. I think life is back to normal and how. But anyway.
I got deeper answer there. We still realize, we have realized the importance of a bigger home, and that thought process will remain. You know, whenever you go back, you'll always realize that for more than 50% of your 60% of your life you spend in your home. So you will tend to look to own bigger and better home.
Yeah, I guess so. But Nitesh, just to take that point forward, the thing when you look at infrastructure companies from an investment angle, is that infra companies historically haven't made you money. Yes, there has been one L&T, but it's for everyone to know who is an L&T investor, what the stock price record has been in the past. What is the reason for the same? I mean, why do infra stocks not make money like any other? And is there any better way you think, perhaps, tactically position yourself in such a way, or, some large opportunity size that one can look at, that the sector does represent, to try and capture the investment angle a little bit better and make more money from the sector?
Yeah. No, so Aisha, you are right. Absolutely. I mean, in the past 20 years, despite this, huge opportunity which has been there, purely from an equity market point of view, the investor did not make any great money in, Indian infra company, barring say a couple of names. I would say there were 3-4 problems. First of all, the infra development model in our country was evolving. Okay, earlier it started with EPC, then it went on to asset ownership through BOT, and then lastly it came the HAM, the hybrid annuity project, where is the government is guaranteeing certain sort of annuity. So the model itself was evolving, and companies were targeting revenue or ordering in that revolving model. Number two was interest rates were very high, particularly the risk weightage for infra companies has always been very high with banks. So the effective interest rate that they pay is much higher than the system-wide interest rate. So that was another problem. Thirdly, if you look at the history of Indian companies, infra company, I would say the capital allocation was also a problem in individual, companies, wherein they went for unwarranted diversification. They went into real estate, buying some large land parcel from the cash flow and things like that. So all this culminated into a scenario wherein the equity returns were depressed. I would say going ahead, there has been a big learning curve which the industry has undergone in the last 15 years. People now understand what is the importance of capital allocation, how you maintain the balance sheet, how you maintain the cash flow. And the investor feedback mechanism has also been quite robust to these companies in the past. So I would believe now going ahead, I think those same mistakes can't be repeated. And therefore, and one more thing is today the ministry, if you look at the Ministry of Transport North, they are very pragmatic and very practical. So for example, in COVID, when the toll revenues were very low, or the developers were facing problems with the cash flow, they came out with a whole list of, ease out policies. So they are very, very pragmatic now, which was not the case maybe say 10 years back. So all this, scenario, I would believe, I think that old phenomena of not making money in infra companies should change. And as I told you in the earlier question, cement cannot remain the only way to play the infra theme. And we will see that some more companies coming up if they maintain the balance sheet and the capital allocation.
Sure. If ITC can do it, I'm sure infra also can. But Jonas, if I could come to you over here, considering one has seen that industrials as a space is a very large umbrella, purely from an investment angle, tell me what are the new sectors that can contribute, you think, or further in, extend the industrial capex cycle 2 to 3 years hence? What are the newer avenues that that an investor can look at beyond the obvious names?
Sure. So, typically industrial cycles globally, last by about 4-5 years. And then even in India, we saw that happen between 2004 running up to 2010-11, where there was massive capacity creation across metals, hydrocarbons, roads, etc. This time around, we are sitting on a decent capacity in those, so-called legacy or old economy sectors. However, there are a couple of other sectors that may come up and drive the cycle longer this time around, and some of them are to do with the new age sunrise sectors. So, be it battery related technology that may come in with the advent of EVs, a host of equipment that goes into battery tech, as we call it, would be one avenue. The other is to do with semiconductors. So, incrementally what we've seen with COVID is a scramble for chips, and there are only a handful of companies or countries that sort of have these manufacturing capabilities, and India wants to sort of develop them ground up. And once that happens, there are a host of, again, engineering components that go into semiconductors. And the third and the last one is hydrogen ecosystem. So the world over, we are looking at decarbonization, and hydrogen is looked as probably the most plausible answer to decarbonization. Again, here we are seeing a lot of activity. In fact, the country sort of announced a draft hydrogen policy a couple of months back, and that will be carried forward. And here again, this is something that will help revive the power sector. When I say power sector, it's not the coal sector, but this will drive demand for renewables. So for instance, a 1 million ton of hydrogen would require 20 gigawatt of power, which will be largely renewable. So, this is likely to sort of play out over a 5-6 year period. And hence, if the current cycle was to continue and, wean off just about the time when these three avenues start picking up, and which is when hopefully we'll have a longer cycle.
Sure. Okay, before I take my next set of questions, we have tons of viewer questions coming in. So let me try and squeeze in a few. Ramchandra Prasad wants to know which 4 sectors will emerge as the best sector on the basis of return as per recent data. And we have a gentleman called Kangaroo. I'm sure that's his ID, and a very interesting name and that, Mr. Kangaroo. But which sector you feel is one where one can invest aggressively for the next 2 to 3 years in equity? Chanchal, you want to take that one? The sectors to bet on for the next 2 to 3 years?
I think from a 2 to 3 year view, as we as a house are very bullish on industrial cycle revival. So industrial is one sector to bet on. We as a house are also very bullish on banking as a sector. So that's the second sector one can look to bet on. And from a long-term structural view, we believe that consumer discretionary, the underpenetration is very high. So that's the third sector. If I were to recall top 3 sectors, I would look to bet from a 3 to 4 year view.
Sure. Hari Krishnan Raghu has said, what's the analyst's view on PSU banks? Which one of you would want to take that question?
Okay, so I'll possibly attempt that one, right?
Sure.
So, our view on the overall PSU banks is that, many people get typically lured by, very cheap valuations in that space, where most of the PSU banks are actually quoting at below book value. But more important parameter to actually look at is that, how is the asset quality of many of these banks in an overall context of, where we are across cycles. And that is where we don't find that many of these PSU banks, are able to sustain, good quality books over the last, if I were to say even 2 decades. And there are, only few select ones where, they have been able to add overall book value on a consistent basis that we're trying to look at. So we would be fairly more optimistic on private sector banks willing to pay a premium to their book values and see that they compound over a period of time, and have a very selective approach to large PSU banks where we find that still there is a very reasonable growth runway ahead of us, and be very selective in that space in the overall context.
Sure, Dhaval, thank you so much for that, and I hope, Mr. Krishnan, we were able to answer your question on PSU banks. But Chanchal, we just have a little time left. I can already see Timothy Moore has already logged in. Chanchal, when one talks about real estate, I think the question is not here of demand, of people realizing that they need bigger houses, and I'm sure real estate companies will manage to pass on, considering it's a very calibrated price hike that they are undertaking as of now, and I'm sure that the price hikes are going to get absorbed. But purely for real estate companies, considering their dark past, do you think capital efficiency under the new regime is something that they'll manage to maneuver through? Chanchal?
Hi, can you hear me?
Yes, I can hear you. Go ahead.
Sorry. Yeah. So if you look at capital efficiency, what has changed in this sector is that REIT has come up in this sector. That means that in the past regime, a real estate developer used to do a commercial, mall, and residential all at the same balance sheet. But today, with the REIT allowed, companies normally divest the entire commercial and retail separately. So that allows them to get the funding. So that's the first big change which has happened. Second thing, if you look at from capital efficiency, most of the developers are not focusing on getting the land bank. The past regime was about land bank and land bank and land bank. This regime is about efficiency. The faster you're able to churn. To give you some number, Aisa, India today, there are no developers doing more than 10 million square foot. And India, top 10 developers would be 15% of the real estate market. China, it's a 38% is top 10 developers. In China, there are at least 5-6 developers doing 30 to 50 million square foot. The same number for a developed market is 78%. 78% of the market is owned by top 10 developers. So this cycle has just started. This number used to be 5-6% almost 3-4 years back when the consolidation happened. Today we have reached to 15%. And I'm sure in this journey, the top 10 developers will command a bigger share. Right. They'll go for a joint venture or joint development, which is asset-light model.
Sure. Okay, great, guys. Thank you so much for speaking with us and discussing all the islands of opportunities that equity investors can look at. Chanchal, Jonas, Nitesh, Dhaval, all of you have a great evening.
Thank you very much. Thanks for having me.
Thank you. Thanks.
Sumit, with that, it's back to you.